Welcome to FinBot Insights. Our purpose is to distill complex institutional research into actionable intelligence for the individual investor. Today, we're turning our attention to fixed income. The global fixed income market represents a colossal $45 trillion in capital. Yet, within this vast landscape, a proven set of investment strategies remains almost entirely ignored. So the question is, why? Why is an approach that has been proven effective for decades in equities almost completely absent in the bond market? Today, we're going to examine the powerful case for applying these exact strategies to fixed income and explore the untapped edge it can unlock for you. Let's begin by looking at this overlooked opportunity. We are going to explore how well-known style premia from the world of equities, factors like value and momentum, can be systematically applied to government and corporate bonds. All right, so what exactly are these styles? Let's precisely define the four core factors we'll be discussing: value, momentum, carry, and defensive, and crucially, how they are measured in the context of fixed income. First up is value, a concept that should be quite familiar to most equity investors. Its core idea is simple, but it's the application to bonds that unlocks its real power. At its heart, the principle is that assets priced below their fundamental worth are expected to generate superior returns over time. It's the classic idea of buying a dollar for 50 cents. So how do we measure value in the bond market? For government bonds, the key metric is a high real yield. That's the nominal yield minus inflation. For corporate bonds, value is identified when the credit spread is high relative to the company's fundamental default risk. The second style we'll look at is momentum. This factor is all about the persistence of price trends. The momentum style is built on the well-documented observation that assets that have performed well recently often continue to do so in the near future. It's about riding the trend. In terms of measurement, momentum for government bonds is typically gauged by their excess return over the prior 12 months. For corporate bonds, it's a bit more complex, often using a combination of the bond's recent return and the company's 12-month stock performance. Now for our third style, carry. For anyone familiar with fixed income, this concept is ubiquitous, often known simply as reaching for yield. The essence of carry is to profit from the income component of a bond. It's a strategy designed to perform well if prices and spreads simply remain static over time, allowing the investor to capture that higher yield. For government bonds, carry is measured by the term spread, that is, the bond's yield versus the short-term interest rate. For corporate bonds, the metric is the option-adjusted spread, or OAS, over government debt. And our final style is defensive. This one is interesting because it posits that safer assets can actually deliver superior, risk-adjusted returns, challenging the simple idea of higher risk, higher reward. Put simply, this is the tendency of safer, lower-risk assets to provide better returns for the amount of risk taken when compared to their low-quality, higher-risk counterparts. So what does a defensive bond look like? In government bonds, it means favoring shorter maturities, giving them lower duration. For corporate bonds, it combines that low duration with strong company fundamentals, like low leverage and high profitability. The theory behind these styles is compelling, but does the empirical evidence support it? Let's now examine the performance data. And the results are quite striking. Looking at corporate bonds, when we sort them into quintiles based on these style factors, the pattern is undeniable. The portfolio of bonds ranked least attractive actually lost money. Meanwhile, the most attractive quintile delivered over 5%. The relationship is monotonic and clear. The more attractive the style characteristics, the higher the return. Now let's consider risk-adjusted returns, measured here by the Sharpe ratio. You can see that all individual styles are positive, but the real power is in the combination. A combined style portfolio in government bonds achieves a Sharpe ratio of nearly 1. In corporate bonds, that figure jumps to an exceptional 2.5. To be clear, these are remarkably high figures. High returns are one thing, but a crucial question for any strategy is whether it provides true diversification or if it simply repackages existing market risks. So let's investigate. The data here is unambiguous. The four style portfolios exhibit correlations to one another that are near zero. This independence is what makes their combinations such a powerful diversifier. Furthermore, when we run a regression analysis, it confirms that the returns from these style portfolios are not explained by traditional risk factors, like the credit premium, the equity risk premium, or the turn premium. This is critical. It demonstrates that these fixed income styles offer a source of return that is truly independent of broad market movements. This is a distinct source of alpha. So let's distill this analysis down to its most critical conclusions for you as an income investor. What is the key takeaway? Style investing in fixed income offers two primary advantages. First, the potential for significant return enhancement. And second, the ability to add genuine portfolio diversification away from conventional market risks. However, a word of caution on implementation is necessary. The academic research explicitly warns that trading costs, especially in corporate bonds, can be substantial. These costs must be carefully considered, as they could compromise an investor's ability to capture these returns in a real-world portfolio. And this leaves the astute investor with a final provocative thought. Given that many active fixed income managers are simply delivering exposure to well-known market risks, could a systematic style approach be a more transparent and ultimately more effective way to generate true alpha? Please remember that this overview is for informational purposes only and does not constitute financial advice. Do not trust social media influencers for your financial decisions. Always conduct your own thorough research. Thank you for watching this FinBot Insights Explainer. If you found this analysis valuable, please support the channel by clicking the like and subscribe buttons for more data-driven content.